Hey, fellow investors, millionaires, future millionaires. Um, how are you today? I had a comment said, can you take a look at TORO Corp? What you think? Um, you got to remember, probably 80% of people who they're just technical people. They don't know what the company does. They have no idea what the market cap is. Usually, they don't even know what they do. They don't know if they're buying cheap or expensive. They're just looking at these graphs and buying based on momentum or um, I mean, if I was just a day trader, I'm looking at this graph here. I don't know what the bad news was, but they're shorting the hell out of it. But number one, I love the market cap because Warren Buffett's not going to be buying this company. Vanguard and all them are not going to be buying it or shorting it unless they're just a lot of times they own everything. So they will have a large percentage of ownership. BlackRock, Vanguard, State Street, those kind of things. But just peeking at this thing, and I had no idea what they do or anything. What I love about this, like I said, number one is the market cap. Number two, the book value per share is $10.29. The cash value per share is $9.27. This has the PE at 0.5. Which is crazy. That's good. Price to book, you're buying it at 50 cents on the dollar. Price to cash, 50 cents on the dollar. This has their earnings per share at $8. This right here is what I really like. You want to see insider ownership. Insider ownership, 50%. That's huge. Institutionally owned, 1.78%. So an institution is probably like Vanguard, BlackRock, those. Return on investment, 43%. Gross margins. This has to be incorrect. Gross margins of 60%, operating margins of 50%, profit margins are almost 200%. Now, it would have been nice to find this thing at $1.93. It's at $4.69 right now. This is Yahoo Finance, has the market cap at $89 $9 million. This one has the PE at closer to 2. Well, even if the PE is at 2, you're getting a 50% return on your money. You get your money back in 2 years, and let's say you hold it for 20 years, you get your money back in 2, and whatever they do profit-wise in the next 18 years is all profit for you. Finvest had their earnings per share at 8, 10, whereas Yahoo Finance has it at 2.87. That's a huge discrepancy. Look what their market cap was back in January, March of 03. It was a $25 million company, and it basically doubled in 3 months. Let's just say this was 60, this is 100, that's a 40% gain in the next 3 months. I don't like how quickly it's grown, but look, it was trading at 18% of book value. So you were basically getting a 82% discount when you bought it here. You're still getting a 50% discount. I don't know how they have such a high profit margin. This has the operating margin at 13%. That's more realistic. This says they got 155 million in cash. They got no debt. So let's think about this. The market cap is $88 million. They have 155 million in cash, and they basically have no debt. Let's just say they have 150 million in cash because their debt is 5 million. So 155 minus 5 is 150. So they got 150 million in cash. The market cap, let's just say, is 90 million. So you could buy this whole company today and make a $60 million profit just from the cash alone. And that's saying the business is worth $0. The book value per share is almost $10 here. Here they got the book value at $10.29. That's I say, this thing is definitely undervalued. This is definitely something that I would buy if I was in a position to do so. Right now, I'm just not in a position to do that right now. I'm in between jobs again. Hopefully I'll be starting to work soon. I just need something steady. It's hard to create wealth when you are bouncing in between jobs. But whether the PE is 0.5 or whether the PE is less than 2, I mean, if you can buy a business for 2 times earnings, that is amazing. What I probably would do if I was in this situation, and I'm looking at this graph here, I mean, you can see like they shorted this thing from October all the way down to November. And and really they really shorted it from September all the way down to the middle of November. So 2 months they basically shorted the hell out of this thing, and then it went back up, and then now they're shorting it again. Now I saw something about a spinoff. I don't know if this is a spinoff corporation. When you look at any kind of stock on Guru Focus, there's always going to be like these warning things. Most of the things are not going to be in green. This thing has a lot of green, and that's a good sign. I mean, this has got their gross margin at close to 60%, operating margin at 47%, net margin almost 200%, return on equity, return on assets, return on invested capital, I believe, return on capital, the Joel Greenblatt formula or whatever. I mean, almost everything is in green. This is very good, and you love to see this. I mean, if you bought it here, you know, they only had $5 million in cash and $16 million debt. Here they got $42 million in cash and $13 million debt. Now they got $155 million cash and $5 million debt. So I mean, and they sold something for like 30 million almost. They sold this, whatever this thing was, for a $30 million profit. And they had net income of $55 million just for the 3 months. And again, I mean, the market cap is 80 million. So if you're getting $50 million profit just in 3 months, I mean, that's huge. I mean, the whole value of the company is only 80 million. I mean, you're basically getting your money back in 6 months, if that's true. Let me see here. Let me see who holds it, if it shows. Alright, let's see the insider roster. The insider roster. Alright, don't really show anything. Alright, well, no insiders are selling, so that's good. I mean, I don't really particularly like the business they're in, which is lawnmowers, and they want to go to electrical lawnmowers. I guess maybe for golf courses and stuff. Let's see, where's a little snippet of what they do? Usually it's over here somewhere, but they've changed the layout. This says Cyprus. I thought they were in Minnesota. I hope I'm looking at the right stock. TORO. See right here, it starts talking about the spin-off. Oh, this is a shipping company. I don't know why I thought it was a lawnmower company. Now I did I did very well on well, I should have done it a lot better, but I did really well on DAC, which is a shipping company. And one of the books I read back in World War One, World War Two, talks about one of the value investors had bought a shipping company, and that was one of the reasons why I had bought it. The only issue with shipping companies, I would say, is there is a lot of capex expenditures and getting these ships, making these ships, maintaining these ships. I mean, let's say you got one of these big ships. Let's say it probably costs $50,000 a month just to let it sit in the harbor for a month. And what I would look at is maybe like occupancy rate, like when I had bought Danos Corporation, which was in Greece, the DAC, the shipping company. They had, I want to say, like a 90% occupancy rate for the next 5 years. But yeah, all I did was go to sec.gov, go to company filing search, TORO Corp. There's a whole bunch of TOROs, so hopefully I clicked on the right one. And another risk would be, let's say, they go by the Saudi Arabia peninsula or something, and a Houthi or something shoots a rocket at it and blows it up. I mean, what's that gonna happen to the company? And there's supply and demand. So this is saying it's cyclical. So if the supply of shipping vessels is high, their profits are going to shrink. Where there's a lot of demand and just a few tankers out there, you think the profitability would go up. Risk of transportation of oil. And the only thing that worries me about a small company like this, I don't know how many ships they own, but let's say a rocket or something did take out 2 of their ships, and they got 5 ships and they lose 2 of them. This is still talking about risk factors. And I don't know. I mean, in the end times, there's going to be wars and rumors of wars. Nation's going to rise up against nation. There's definitely going to be wars. And if you're shipping oil from country A to country B, and country B is in a little shady area, that's definitely a risk factor to consider. It says the worldwide tanker fleet grew by 3.5% and 1.9%, whereas the orders stood at an increase of 4.45%. So to me, that tells me that they're not building enough ships to cover the demand. Just like manufacturing, for example. Manufacturing in general is a dying industry because the productivity of robots or whatever, maybe they change the layout in the room so it's like more ergonomically correct, so you're not having as many hand injuries or elbow injuries, and you're more efficient. And when you're more efficient, or you have technology that robots doing the jobs of humans, basically what I was saying is the demand is like the efficiency goes up like maybe 8%, whereas the demand might be at 4% or something. And then so every year you need less and less people to do that job because you're more efficient, you're getting better assembly lines, you're more economically correct, you got a new piece of equipment that makes life easier. You can just push a button instead of doing it the old way, and robots and stuff. I would like to know how many ships they have. My guess is they don't have very many. Maybe 5. So because I had done research on DAC before, that helps me a little bit when you're looking at something like this. All right, the average age of our carrier fleet was 7.5 years as of February 29th, compared to the industry average of the world fleet of small LPG up to 5,000 whatever, which was 22 years. So if their average fleet is only 7.5 years, and the average is 22 years, they're looking good. So they don't necessarily have to build new ships for a little bit. Okay, this is the average age of our tanker fleet, comprised of one vessel as of such date was 18 years. The age of our tanker vessel may impede our ability to obtain external financing against that vessel at all, or at all reasonable terms of our tanker vessel may be seen as less valuable collateral. So actually that's not good. that their tanker is 18 years old and the average age is 22. We do not have a declared dividend policy, and our board may never declare dividends on our common shares, on our peasants. So if you're a dividend investor, you might be turned off by that, but when I had bought DAC, I don't even think they were paying a dividend back then, and they started paying a dividend. So talking about to pay tax on U.S. income, maybe litigated, anti-fraud, changing tax laws. These are all like risk factors for basically any company. So they do have preferred shares, it looks like. So maybe they do a dividend for preferred shares, I'm not sure. Well, I guessed what, 5? Didn't I say 5 vessels? 1, 2, 3, 4, 5. So they got this one larger one. Isn't that the one they just sold though? This MT Wonder. Right here, they sold the MT Wonder for $28 million. So this one's gone. So now they got a fleet of 4. This one was just built in 2020, and these in 15. So the fleet is still fairly young. So this is the gross charter rate per day. $1 million lump sum, $310,000 per month, $308,500 per month, $314,000 per month. So I would be curious as to what the occupancy rate of these vessels are for the next, say 5 years. So I believe these are the smaller ones. Our vessels are commercially and technically managed by Caster Ships, a company controlled by our chairman, and chief executive officer. I still don't understand about the spinoff, because I do love spinoffs, because the reason I love spinoffs is a lot of times people, they don't know what the hell a spinoff is, and they just dump the shares. Well, a company like Avi, people love that stock. They love that as dividend investors. They love Avi. Avi was a spinoff. There's a lot of companies that were spinoffs. They might spin off their whatever division and create another company with it. And so usually spinoffs are great investments, because a lot of people, they would just sell. I don't even know what the parent company of Abbey was, but let's say it was Johnson & Johnson, for example, and they spun off one of their divisions and turned it into Abbey. Well, if you own Johnson & Johnson, a lot of times you're just going to sell those Abbey shares, because you might have 100 shares of Johnson & Johnson, and then all of a sudden, now you got 20 shares of Abbey or something. And but 20 years ago, or whenever it spun off, like, you didn't know what the hell it was, and you just probably just sold it. So a lot of times you can get a really good deal on the spin-offs, because a lot of people just sell them not really knowing what the hell it is, or what, or don't want to wait 10 or 20 years for those companies to mature and take off. Now they're talking about emissions and stuff. There has been a war on fossil fuels. But I do like looking at these small companies, because there's only so much assets and stuff you can look at. I mean, you can go back and research we know this one sold for $28 million. I don't know what the price of this one. Let's say they're $10 million a piece. That's $40 million right there. And they might be more than that. I don't know. I'm just taking a guess. But you can look it up and probably figure out, based on how old it is. Like, I would say this one, since it's newer, maybe this one's worth $15 million, and maybe these are worth 10. So 10, 20, 30, 45 million just in the vessels. And that's just a guess. I really have no idea. But I do know here locally, just to build a little yacht is around $2 million. So I would think a tanker vessel would be more than a little yacht that's not even really that fancy. Well, I don't want to say that. I mean, but I'm just talking about a small boat. I'm not talking about a big one. So total vessel revenue 110 million, and then 80 million. Voyage expenses 30 million and 5 million. Revenue, available days, so I don't see, okay, fleet utilization rate, 94% for this one. 99%, 98%, 97%, 100%, 100%, 100%. So basically they are being used almost every day, which is good, but I don't know if they got contracts for the next 5 years. You know, let's say office space right now in the USA, about 1 in 4 are occupied. The other 75% are vacant. And if you're a landlord to office renters and their utilization rate is like 25%, you know, they're not getting the income to pay the rent, and that's why you're seeing companies selling their office property at a loss. But having 100% utilization rate is very good. That's a good sign. Obviously, you would like to see the total vessel revenue going up instead of going down. I mean, to go from 111 million down to 78, that's not a good sign. Alright, and it's saying why. It was largely driven by the decrease in the available days of our fleet. From 2,738 days down to 3,000. And it talks about the Wonder. So, I mean, they did sell it for 30 million, but that's also money that they're not going to be making too from their, you know, voyage expenses decrease. That's good. Decrease in vessel operating expense by 0.6 million. That's good. Increase in management fees. I would say that's not good. And then they're talking about depreciation in the fleet. You know, if you buy a piece of equipment, let's say for $300 year one, you know, let's say that value of that equipment in year two is maybe $280, and year three it might be $260, and then in year four it might be $240, and then eventually they just, you know, value it at zero, even though it could still be useful. So that is some way that you can find sometimes hidden value where they're valuing a piece of equipment or something at zero just because it has been depreciated. But I mean, I still got a microwave that I bought in college for, I don't know, probably $30, and it's stronger than a lot of the modern microwaves. It still works. I mean, all right, it's talking about sell that ship. But I don't even need to go further. I mean, just a quick 5-minute glance at this thing is screaming buy to me. This says a PE ratio of less than 2, market cap of, you know, $89 million. They got $150 million in cash. They only got four vessels, but they're all profitable. You got everything here in the green, almost, which is nearly impossible to see ever. You know, you look at any company on here. Let's look at ExxonMobil or something. I mean, yeah, they got a lot of things in the green, but they got a lot of stuff that's not in the green too, including a lot of debt. So when you look at this company, they got all these things in the green. All these things. That's huge. And not only that, they got the net current asset value at $1.78, the tangible book value is at $9.31, and the Graham number, Benjamin Graham, he had a little formula, so this is taking Graham's formula into account, $11.01. So if you're a big Graham person, you know, you're buying this thing at $4.78 and you think it's worth, let's cut these in two and let's just say $10. You know, so, but looking at the graph here, I have a feeling this thing's going to keep going down until there's some kind of resistance, and there hasn't been a resistance yet. I mean, who knows? It could flip back around and go up tomorrow, but I mean, this trend line is still going up. But I mean, if you go from here to here, it's still going up in an upward direction. But this thing right here, what I would do, this is what I would do. I would say, you know, I don't know how much capital you're working with. You know, you might be working with $1 million. But let's just say you're working with small amounts of money, and like me, like maybe I would buy 100 shares for, you know, less than $500 tomorrow. Buy 100 shares, and then watch it for a couple weeks, and then maybe in 2 weeks it goes to 350, and then maybe you buy 200 shares, and then maybe another 2 weeks it goes to 250, and you can buy 300 shares, 400 shares. So I mean, I would start a small position, but get ready to double down, triple down, quadruple down if you need to, or whatever you're comfortable spending. Let's say, hey, I only want to risk $1,000 in this company. You know, maybe you invest $100 here at this price, and then if it goes down to 4, add another 100. If it goes down to 350, add another 100, another 100, or something like that. And because you don't want this to happen. I mean, if it's here and it goes, oh, it just gets killed from here, from 650 all the way down to 350. Then then you basically lost half your money, and you need 100% gain just to break even, just to get back to even. Yeah, you bought here and sold here. Yeah, you lost 50%, but you need 100% gain just to get back your money back. So the 52-week range is 2. Where is it at? Less than 2, $1.93. So I would be cautious about loading backing the truck up at 460. Because I mean, it's in a downward trend, it's in a downward momentum. But the nice thing is that institutionally, insiders own 50%. So to me, this would be the floor down here somewhere, probably 350 or $3 maybe, and then hopefully the insiders would start buying at $2, $3, and push this up here. So to me, you're protected on the downside because you got 50% ownership by insiders. Pretend like this is Warren Buffett, and he's never selling. Now I don't know these owners. Maybe they're not Warren Buffett's, and maybe they would sell in the future at some point. I don't know, but I would be cautious at buying at this price just because it's in a downward momentum. But I would say start a position, and then if it keeps falling, you just buy more. If you're willing to buy a hamburger at $1 and you go into McDonald's tomorrow and they want to sell you 2 hamburgers for 50 cents, that's a bargain. But this company is not without risk. Like I said, they only got 4 vessels. So if something happened to one of their vessels, their revenue goes down 25%. If something happened to 2 vessels, their revenue goes down 50%. But the PE ratio is good, the earnings per share is good, the market cap is good. They got enough cash. They got 150 million in cash, and the market cap's only 89 million. So you can buy the whole company today and make a $60 million profit. In theory, anyway. These guys are young. Look at these senior management guys. 33, 33, 32. The CFO is 56. I wish I knew a little bit more about so it looks like they do have some preferred shares. And Perry purchased 8,500,000 common shares at a purchase price of $2.29. Our chairman and CEO owns 51.9% of our outstanding common shares, and 99% of the voting power. Well, if he wanted to pay himself a dividend, he would surely be making some money. So I don't know off the top of my head what the dilution rate is, what the, obviously if the company is adding more shares to the pool, that is decreasing your ownership in the company. But just the few things that I've seen, I love the 50% inside ownership. I love the market cap. It's a small market cap. So the big hedge funds and stuff aren't going to be looking at it. It's not worth their time. It's not worth their energy. But yeah, if you could have bought some at 2, and it goes to 6, that's a triple up. If you're buying at this price, it needs to get, closer to 10 for you to get a double up. Whereas if you bought it at 2 and it goes to 10, that's 5 times your money. But yeah, if I'm buying this, I'm buying it purely on an asset play. Imagine the company is worth 0. You're just buying it for the fair value. You're buying it at 50% of book value. You're buying it for the book value per share is $10. You're buying it for the cash. Now who knows, maybe in the next 2 to 3 years, maybe they add 2 more ships to their fleet. Maybe they add 5 more ships to their fleet, or 4 more ships and double their fleet size. And instead of making 30 million a quarter, maybe they're making 100 million a quarter. So this thing definitely has the potential to for long-term growth. I don't know why what the peg value is. You like to see this, and I don't know why they don't have a 4 PE. Ideally, you like to see the peg less than 1, because that means they're going to be growing. And basically, as a value investor, you want the growth for free. You don't want to pay for it. You know, if you're buying Google or something, you know, like back when Google was maybe like 30 times earnings, you know, you're paying for growth because, you know, they're doubling their revenue, or Apple or something. They're doubling their revenue every year. So, yeah, thanks for the comment, man. I really appreciate it. Appreciate you checking out my page and my YouTube channel. And yeah, I think this is worth taking a stab on. And to me, you really don't know what you have until you own it. And I know that seems bad sometimes to say, but you don't really know what you have until you're in it. And I don't know, maybe down the road they do some shady stuff or whatever, and you don't particularly like something that they did or something that they said, and get rid of it, you know. But I think this is a really good deal. I mean, you're getting 50 cents on the dollar. Whether the PE is 1.63 or whether it's 0.5. I mean, if you can buy a company at 2 times earnings, that's great. You know, I've use the reference of buying a house, and you know, let's say you buy a house for $200,000 and you rent it out for $20,000 a year during the beach season or whatever for 13 weeks or whatever it is, and within 10 years you got that house paid off, and then everything after that is profit. But here you're getting your money back in half a year or 2 years, somewhere in there. Half a year or 2 years, you're getting your money back, and everything else is profit. Assuming this company still exists and doesn't go bankrupt or blown up by the Houthis or whatever the hell they are, with a rocket or something. But yeah, this looks like a great investment, and it looks like the chances of losing your money are almost zero, in my opinion. I mean, yeah, it's possible to lose money, but if you hold this for long enough, I don't think you're going to lose money. You know, like I said, what I would do, I would start a very small position tomorrow, today, whatever, and then expect it to go down. Usually as soon as I buy something, it goes straight down. You got to be ready and confident to double down, triple down, and then, you know, maybe you got a limit. Say, hey, I'm not putting more than $1,000 in it. I'm not putting more than 10 grand. I'm not putting more than 20 grand. Whatever your limit is, try to space your buying out. Maybe in weekly intervals, or 2-week intervals, or monthly intervals, or 3-month intervals, whatever you're comfortable with. But to me, if the 52-week low is $2, if they just issued 8 million new shares, 8,500,000 new shares, and the owner bought it at $2, Um, I would try to get as many shares as you can closer to the $2 range, as opposed to closer to the $5 range. And who knows? Maybe this thing just goes straight up from here. But looking at the chart here, it looks like this in a downward trend. So, it was down 4% today. After hours up 3%, but I don't know. Maybe it'll be down 7% tomorrow. And this is the volume is low, so the average volume is 49,000. The volume today was 45,000. So to me, that is a negative thing, because let's say the average volume is 50,000 and today's volume was 150. Well, then you got 3 times the interest out there. And you can calculate that and, multiply 45,000 shares by, $5, and that tells you how much let's just say it was 50,000 times 5. That's what, $250,000 trading hands every day, and the market cap's 90 million. So you got a very small percentage, $250 million trading hands every day out of a company that's worth 90 million. But anyway, thanks for watching, man. I appreciate you finding this little diamond in the rough, and I'll be open to, if you got some more to look at, I'll be happy to take a look at them and give you my opinion. Thank you, man.